In this episode, we're going to answer the following questions. How long do I need to stay invested? And is it too late for me to start investing today? Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, we're going to cover the following 6 topics. We're going to look at the Simply Investing approach. Then we'll look at how much time does it mean when we say long-term investing. And then why long-term? Why is that important? And then we'll look at how long should I stay invested? And then finally, we're going to take a look at, is it too late for me to get started today? And then we're going to finish off the episode with 2 real-life examples of long-term investing. So what is the Simply Investing approach? This approach is to help you build a resilient portfolio that provides you with growing dividend income each year. The key words here are resilient, growing, and the income increases every year. So resilient means that the portfolio is going to continue to give you increasing income regardless of what happens in the stock market. And then, of course, as dividend investors, we want our dividend income to increase every single year. So how do we do that? We do that by investing in quality, dividend-paying stocks when they are priced low. So how do you know when you're looking at a stock anywhere in the world if it's a quality stock, and how do you know if it's priced low? So for that, I've created what I call the 12 rules of Simply Investing. The rules are designed to lower your risk, save you time, and help you earn more. You can see the 12 rules up on the screen here. And the way it works is you want to make sure that before you invest in any company, that it passes all of the 12 rules you see here. If there's a single failure, you want to skip the company, move on to something else. So let's take a look at the 12 rules very quickly. Rule number 1 is, do you understand how the company is making money? If you don't, skip it. Move on to something else. Rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is the company recession-proof? Rule number 5, is the company profitable? Rule number 6, does the company grow its dividend? Rule number 7, can it afford to pay the dividend? Rule number 8, is the debt less than 70%? Rule number 9, avoid any company with a recent dividend cut. Rule number 10, does it buy back its own shares? Rule number 11, is the stock priced low? So we look at 3 things there. We look at the PE ratio, the PB ratio, and we compare the current dividend yield to the company's average 20-year dividend yield. And then rule number 12, keep your emotions out of investing. So the Simply Investing approach helps you to invest in quality stocks, not just any stock. Invest in undervalued stocks, meaning when they're priced low. And, of course, dividend stocks. So then what are dividends? For many of you that might be watching this episode for the first time, it's important to quickly review what exactly are dividends. The dividends are essentially the company sharing its profits with you, the shareholder. So if we have a company, for example, that's paying a dividend of $1 per share, and that's an annual dividend, and you own 1,000 shares, you will receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend. Now, the stock price can go up and down, and stock prices do go up and down all the time. As long as you own those shares, and in this example, 1,000 shares, and as long as the company is paying the dividend, you will receive that money as cash. It's deposited directly into your trading account, and you can spend that money if you wish, or you can reinvest it into other companies that are paying dividends. Now let's move on to our topic number 2. You've heard me say this before. We are long-term investors, long-term dividend investors. So what exactly do we mean when we say long-term? Is it 6 months? Is it 8 months? Is it 12 months? what is it exactly? So it's quite simple. It's approximately between 5 to 10 years. So what that means is if you are saving your money to buy a house or a car or some other investment, large investment that you want to pay for, or anything else, or even a vacation, and if you need that money in 5 years or less, then do not invest it in the stock market. And that means don't invest it in mutual funds, index funds, and ETFs as well, because what they do is they turn around and they buy stocks using your money. And so we want to make sure that we're investing for the long term. And that's the next topic. Why? Why do we want to invest for the long term? Why can't we invest for 12 months or a year or even 2 years? And so let's take a look first at stock prices. And I'm going to give you a real life example here. We're going to take a look at Walmart. So this is a 1-day price chart of the Walmart shares. And you can see, like I said before, stock prices go up and down all the time. And you can see the graph up on your screen. This graph represents a single day. And you can see the stock price goes up and it comes down, it goes up, it goes down, it goes up again. In this case, it actually ended the day lower than when it opened. So if you were to take a look at this, just this graph, you would say to yourself, well, I don't think Walmart is going to be a good investment. The stock price has gone down. If we take a look at the 5-day chart, so this will be Monday to Friday, again, stock prices go up and down all the time. And in this case, just so happens the last 5 days that I picked as of this recording in the year 2025, you can see that the stock price actually ended the week lower than when it started the week. And so again, if you're going to base all of your investing decisions on just looking at this one graph and nothing else, you would say to yourself, well, I don't think Walmart is a good investment. I can see from this 5-day chart that the price has just been dropping, getting lower and lower. Let's do one more. We look at a 1-month price chart. And again, prices go up and down. Here we can see that after a month, the stock price is right back where it was 30 days earlier. And again, if this is all you're looking at is this one chart, the 1-month price chart for Walmart, you might say to yourself, well, I don't think this is a good investment. The stock price hasn't gone anywhere. The return on your investment in 30 days is going to be 0%, right? Because the stock price is right back where it started. So these are all examples of short-term investing, right? We looked at the 1-day price chart, 5 days. Now we're looking at a 1-month price chart. This is all short-term. We want to look at long-term because we are long-term investors. And now if we take a look at the last 25 years, you can see that the Walmart stock has done really well. And you can see it up on the screen here. And the graph, you can see that the line long-term has gone up, 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 and up. So the company has done really well. If we just take a look at the numbers, you can see that the price of Walmart, a single share, back in 2000 was $14.42 a share. Now, as of this recording, the stock price is $94.40. That is an increase of 555%. Now, that's just looking at the stock price. So that's capital gains. If you were to buy it back in 2000 and now you sold it, your capital gains, your profit would have been a little over 555%. What we didn't look at is the dividends. So let's take a look at the dividends. Again, we're going to start with a short-term look. So this is the 1-year quarterly dividend chart for Walmart. And if you look at this chart, it doesn't look remarkable at all. And if you take a look at it, you notice that the dividend has gone up, but just a little bit. I'm going to guess here it's a little under 21 cents a share. That's the quarterly dividend. And it goes up to 23.5 cents. So that is not a huge increase. You're not going to get rich off of the 3.5 cent increase here. But we're just looking at the 1-year chart. Let's take a look at the 3-year chart. Similarly, same thing. We can see that the dividend has gone up, the quarterly dividend, so that's good. But again, it's not a huge jump. These are pennies, just a couple of cents here and there where it's going up. So if you were to just look at the 1-year dividend chart or the 3-year dividend chart, you might say to yourself, I don't know if Walmart is going to be a good investment, right? There's not a lot of opportunity here to make a good return on your investment. Now, if we look at the 25-year quarterly dividend chart, you can see that the dividend has gone up considerably. In fact, it's gone up every single year in the last 25 years. So here we're looking at 25 consecutive years of dividend increases. So if we look at the numbers, the dividend back in 2000 for Walmart was 2 cents a share. The dividend today is 23.5 cents a share. That's an increase of over 1,000%. So that is a really good rate of return. And you don't see increases like that in other types of investments. If you're looking at fixed income, for example, it wouldn't go up that high. So that's remarkable. The dividend has done really well. So in the short term, stock prices and stock markets go up and down. In the long term, we see that the markets tend to go up. So you don't want to be in a position where you need the money in 2 years or in 3 years and the market is down 15%. And then you have no choice but to sell low. And we don't want to be doing that. So having a long-term perspective gives you the opportunity to sell when eventually prices will be high and they'll be overvalued, right? So when it comes to investing, you need to keep a long-term perspective. There's 2 benefits here. One is the long-term compounding of your returns. As you keep getting dividends, as the dividends go up every year, that's more money in your pocket. You can take those dividends, if you don't need the money right away, reinvest it into other stocks that are paying dividends that are also growing their dividends. So you can compound your returns over the long term. And then also the market volatility tends to smooth out, right? As I showed you in the example, the 1-day price chart is like up and down, up and down. 1 month, same thing. A year, same thing, but it kind of smooths out the highs and the lows. And then when you look at a 5-year, 10-year, 15, 20, 30-year stock price chart, you can see that it smooths out a lot of the highs and lows. So that is going to be the best approach when it comes to investing. We want to take a look at the long term. The next topic in our episode here is, how long should I stay invested? Do I only need to invest for 5 years, maybe 10, maybe 12, and done? Like, how long should I stay invested? Well, the short answer is the longer, the better. The ideal length of time to stay invested in stocks really depends on your financial goals, risk tolerance, and life circumstances. But as a general rule, you should plan to stay invested for at least 5 to 10 years. That's what we talked about at the beginning of this episode, and ideally, decades. So to highlight this point, we're going to take a look at a quick example with Johnson & Johnson. Imagine you invested, I put it as an example, $5,000, but it doesn't really matter. It could be $500, could be $100, any amount that you invested back in 2005. After 1 year, you decided to sell all your shares in Johnson & Johnson. Well, you would have lost money. You can see here that the rate of return, including dividends, would have been negative 0.8%. So just after a year, any investment in J&J, you would have lost money. Had you kept the money in there for 5 years, and then you decided to sell, let's say in 2010, you decided to sell your shares, well, then you would have made a gain of 17%. So that's a little bit better. What happens after 10 years? Well, now your gain would have been 99%. Again, that's including dividends. After 15 years, 181% return. And then after 20 years, more than 258% return. So you can see this really highlights the fact here, and when you look at the numbers on the screen, the longer you held on to your shares in Johnson & Johnson, the greater your return was with the stock. And this is the reason why we are not day traders, right? We don't do that. We don't buy and sell stocks on the same day. And some day traders will make hundreds of transactions in a week. And we just don't do that. It's right. Prices go up and down all the time. And we are looking at how to invest our money safely for the long term and for long-term growth. And you can see in this example right here, that is a huge difference in 258% return versus 17% return. Now, the other question I get a lot, and that's the next topic here, is am I too late to get started with investing now? So the answer is that's going to depend on your age. Now we've got some parameters here. You can see if you're under 20 years of age, it's not too late. In fact, the sooner you can start investing, the better. We've had folks who started investing when they were teenagers. Myself, we had the kids start investing when they were 9. The younger you can start, the better off you will be. If you're in your 20s and 40s, still not too late. You should get started investing right away. And we can see in the last couple of slides we looked at, the longer you stay invested, the greater your returns. What if you're in your 40s and 60s? Again, not too late. The bigger question here is going to be for someone who is older than 60 years of age. And that's where a lot of the questions come from that type of demographic that I do get, is someone who is older than 60 years of age, and now they're wondering, is it too late for me to start investing with this approach? Let's take a really quick look at a very simple case study. And this was a 60-year-old male who contacted me, was looking to start with dividend investing, had approximately $185,000 to invest. That was all of his savings and retirement accounts. In the US, it would be a 401k or an IRA. In Canada, it would be an RRSP or a TFSA. So all of those accounts had $185,000 to invest. And I was asking the question, is it too late for me to start investing? Now, only you can answer that question, but here is some help, and I'm going to cover that right now. So, a number of things you need to consider before you decide, should I invest this way or not? So, how is your health? So, in this case, the gentleman was 68 years old. How is their general state of health? Because with good health, you could live for another 20 to 30 years. And that is long-term investing. So even at the age of 68, you have another 20, 30 years to go. Do you have any other sources of income? So this individual, that's the question I had asked. Is there a side business? Is there a rental income? Is there part-time work? Maybe you're working 2 days a week. You're doing some consulting, or a workplace pension that you're receiving. So all of those things will come into play in your decision of whether or not dividend investing is for you. And we know because $180,000 total is not going to generate a lot of dividends in this year, right? As you've seen my previous episodes, the benefit of dividend investing gets better and better the longer you stay invested. So in the beginning, the dividends are going to be very small, right? A lot of people say that they're insignificant. They're very small. But as the dividends grow every year, then your income starts to grow. As you start taking that and reinvesting it into other dividend stocks, then your income starts to grow. So $185,000 invested today is not going to generate a lot of income for you to live off of. But if you can stay invested for the long term, eventually it will. The other question I had asked the gentleman was, do you have any dependents? Because that's going to weigh in on your decision. Am I ready to put this money into the stock market where I'm not going to touch it for the next 5 to 10 years? Because like we said before, if you're investing for less than 5 years, the stock market is not a good place for short-term holdings. What is your monthly living expense? So that's going to depend on who you are, your lifestyle, and where you live. And that's, of course, our last bullet point here is what kind of lifestyle do you want to maintain? So even if you're in your 60s, in your 70s, or 80 years of age, the other thing to consider is the type of financial freedom that you would like to leave for your family and children. Because as you get older, of course, you don't have a lot of time left, but are there certain decisions that you could make today that your children and family could benefit from as well in the future? So there's a lot of things to consider. It's a decision that only you can make ultimately at the end of the day. But there are opportunities, if you can stay invested for the long term, to generate significant dividend income. Now let's take a look at two examples of long-term investing. So we're going to take a look at two real-life examples and see what the returns are like. How much dividends can you expect to earn? What do the returns look like after investing for a while? So we're going to take a look at two examples, Johnson & Johnson and Pepsi. So in this example, we're going to assume that you invested $5,000 each in Johnson & Johnson and in Pepsi back in 2005. So as of this recording, so that's 20 years back. So 20 years ago, you invested $5,000 in each of those two companies. Let's see what the results look like. So first, we're going to take a look at the dividends. So if you put $5,000 in Johnson & Johnson back in 2005, today, if we add up all the dividends received since 2005, you would have received over $5,200 in dividends. So that's pretty good. You've recouped your entire investment. Anything after this is going to be pure profit, and you've made your money back already with your investment. Now, I know it's taken 20 years, but this is the fact. You've received over $5,200 in dividends. If we take a look at Pepsi, it's done even better. Pepsi would have generated over $6,095 in dividends since you invested in the company. Now, if we combine them both, so it's a $10,000 investment back in 2005, would have generated, the total portfolio here would have generated over $11,200 in dividends since 2005. Now, if we look at more closely, this specific year, as of this recording, your investment in Johnson & Johnson this year would generate $420 in annual dividend income. So that is if we do a dividend yield on cost, that's 8.4% return on your money just by holding on to those shares. Regardless of what happens in the stock market, regardless of what happens to the share price, you are now earning, as in this example, 8.4% return on your investment while you hold on to those shares. If we take a look at Pepsi, it's done even better. Pepsi today would generate $552 in dividend income, and that's an 11% dividend yield on cost. If we look at it together as a portfolio, again, total investment was $10,000 back in 2005. Your total investment is now generating a little over $972 a year in dividends. That represents a 9.7% return on your investment while you hold on to those shares. So that's not bad. That is way better than what you would get in a fixed income fund, for example. And so that's just holding on to the shares, just looking at dividends. We haven't even considered stock prices. So now let's move on and look at the stock prices. So Johnson & Johnson, again, $5,000 invested back in 2005. Today, including dividends received, your investment would be worth over $17,800. So that's a 258% return. If we take a look at Pepsi, again, $5,000 invested back in 2005. Today, including dividends, would be worth over $19,200. So that's a 284% return on your investment. So that's pretty good. If we combine both of them into one single portfolio, so $10,000 invested equally between the two companies, today would be worth over $37,115. That's a 271% return on your investment. So as you can see, the longer you stay invested, the greater your return. So you can make good money on capital gains as well as dividends, because in this example, both of these companies have consistently increased their dividends. In fact, if we go back to 2005, the dividends have gone up consecutively for the last 20 years. Now, let's take a look at the last question here. So then, does this mean that you should go invest in any dividend stock for the long term? Just go out and buy them all and hold on to them for the long term? And the short answer is no. Remember, our approach to investing is to keep it simple. We want to help you build a resilient portfolio that provides you with growing dividend income each year. And how do we do that? We invest in quality dividend-paying stocks when they are priced low. And how do you know when they're priced low, and how do you know when they're quality stocks? Well, like I showed you at the beginning of the episode, I've created what I call the 12 rules of Simply Investing. The rules are designed to lower your risk, save you time, and help you earn more. You can see the 12 rules up on the screen. I'm not going to go through them again because we already went through them at the beginning of this episode. And if you recall, the way this works is you want to make sure a company passes all of the 12 rules before you invest in it. We have an all-in-one solution. We've spent many years building a web application and building the Simply Investing Dividend course. The web application will apply the Simply Investing criteria to over 6,000 companies in the US and in Canada every single day. So when you log in, you can immediately see which companies are worth considering to invest in and which ones to avoid, because the application will show you which ones are undervalued, which ones are overvalued, which rules they fail, which rules that they pass. So this is going to save you a lot of time in determining what to invest your hard-earned money in. The Simply Investing course is a self-paced online course. We've got 10 modules here. It's a video course. Module 1, we cover the investing basics. Module 2, we cover the 12 rules of Simply Investing in detail. Module 3, you learn how to apply the 12 rules. Module 4, we show you how to use the Simply Investing web application. Module 5, you learn how to place your first stock order step by step. Module 6, you're going to learn how to build and track your own portfolio. Module 7, you're going to learn when to sell, which is just as important as to know when to buy. Module 8, you're going to learn how to reduce your fees and risk, especially when it comes to mutual funds, index funds, and ETFs. Module 9, I'm going to give you your action plan to get started right away. And Module 10, I answer your most frequently asked questions. If you're interested, you may want to write this down. We have a coupon code, SAVE10, SAVE10. SAVE10 is going to save you 10% off of our all-in-one solution. So you get the course and access to the web application. If you enjoyed today's episode, hit the subscribe button, hit the like button as well. And for more information, take a look at our website, simplyinvesting.com. Thanks for watching.